The real AI risk isn't chips, it's hidden debt. Turn on the news and you'll hear the same headlines. AI chips are selling out, data centers are breaking records, and the future is being built at lightning speed. But almost nobody is asking the obvious question, who is paying for it? Because here's the truth. Meta, Google, and other giants are building $26 billion projects, and they're doing it with debt that doesn't even show up on their balance sheets. In our last video, we showed you why the AI bubble is really a credit bubble. Check it out if you missed it. The link's in the description. Today, we take that story further. Because the real risk isn't just credit in general, it's the hidden debt structures powering this boom. The AI boom isn't just chips. It's power plants, water rights, and entire cities of servers. Take Meta's Hyperion project in Louisiana, a 4 million square foot campus designed for 5 gigawatts of AI compute. Meta just secured $26 billion in debt financing for this one site. To put that in perspective, that's bigger than the GDP of dozens of countries. And yet, when you look at Meta's financial statements, you won't see $26 billion in new debt. So how is that possible? The answer is something called off-balance sheet financing. Here's how it works in plain English. A joint venture is created to own and build the facility. That JV borrows the $26 billion from investors, while Blue Owl adds $3 billion in equity. Meta signs a 20-year lease to occupy the space. So on paper, the debt belongs to the project, not Meta. But there's a catch. To win over lenders, Meta offered a residual value guarantee. If Meta terminates the lease early or doesn't renew, and the project's value falls below a threshold, Meta must reimburse investors for losses. Think of it like leasing a car, except instead of a $30,000 vehicle, it's a $26 billion campus, and Meta is guaranteeing the resale value. Why go through all this trouble? Because data center finance has entered a new era. Just a few years ago, projects were 20 megawatts at a time. Now, they're mega campuses the size of small cities. And AI infrastructure ages quickly. Cooling systems, chips, and power design can all be obsolete in less than a decade. So even the most eager lenders demand protection. Meta's guarantee doesn't cover interest payments, but it shields investors from the nightmare scenario. A half-used shell worth far less than it cost to build. That guarantee was the linchpin that fueled a bidding war among Wall Street lenders. If this sounds familiar, it should. In the 1990s, Enron used off-balance sheet vehicles to hide risk. In the 2000s, Wall Street pushed mortgages off-balance sheet into so-called safe securities. Today, big tech is using them to build AI. The difference? This isn't fraud, it's legal, it's clever, and it's huge. But the DNA is the same. Risk doesn't disappear, it just moves into the shadows. For investors, here's the problem. Meta's official debt looks low. But economically, it's still on the hook through lease payments and guarantees. That means hidden leverage, higher operating costs, and potential liabilities if the AI cycle slows. And this isn't just Meta. JP Morgan is already working on a $38 billion financing package for Oracle's data centers. Analysts estimate $150 billion in financing needs just in 2026 and 2027. The Hyperion deal isn't a one-off. It's the template for a shadow debt boom across the AI industry. The real AI risk isn't chips. It's the hidden debt structures being built behind them. This is Global Notes by JP, where we go past the headlines and into the plumbing of the global system. If you found this useful, hit like, share it with a friend, and subscribe for weekly deep dives. Thanks for watching.